Did you know that nearly 90% of new investors lose money in the stock market within the first year? It's a shocking stat, but it's true. Many beginners jump into investing without a clear plan and end up losing their hard-earned cash. But what if there was a way to avoid this? What if you could learn how to invest like the pros, without taking unnecessary risks? That's where value investing comes in. It's not about chasing trends or hoping to get lucky. It's about finding solid companies that are priced lower than they should be, then holding on for the long haul. Warren Buffett, one of the wealthiest people in the world, made his fortune using this exact strategy. In this video, we're going to dive deep into the secrets of value investing, showing you step by step how to start building wealth the smart way. From understanding key metrics to balancing risk and reward, you'll learn everything you need to know. If you're ready to stop gambling with your money and start investing for the future, this guide is for you. Stick with us, and by the end, you'll have a solid plan to start your value investing journey today. Chapter 1. The truth about get-rich-quick schemes. Why patience pays. If you've ever seen a flashy ad promising huge returns overnight, you're not alone. There's always a temptation to chase quick wealth. But here's the thing. The best investors understand that patience is the secret weapon. Dave Ramsey often talks about delayed gratification, and it's the same idea here. Investing is about playing the long game. The stock market can be volatile. In fact, the S&P 500 has averaged about 10% annual returns over the last 90 years, but it's a bumpy ride. Some years are great, others, not so much. What separates the successful investors is their ability to stick to their strategy, even when the market seems unpredictable. Here's an interesting fact: over 80% of day traders lose money. Those chasing quick returns usually pay the price. Why? Because they react emotionally to market changes rather than focusing on long-term growth. Value investing is all about finding solid companies that are underpriced and holding on to them. Value investors are like treasure hunters, always looking for gems that others overlook. This approach isn't flashy, but it works. And it's a strategy that builds wealth over time. Dave Ramsey stresses the importance of staying disciplined, and value investing fits perfectly with that mindset. A study by the National Bureau of Economic Research found that the average investor underperforms the market by about 2% each year because they buy and sell based on emotions. By sticking with long-term, steady investments, you avoid those costly mistakes. Remember, slow and steady wins the race. Warren Buffett, the king of value investing, says, "The stock market is a device for transferring money from the impatient to the patient." It's a simple, powerful idea. Invest with patience, and the rewards will come. Chapter 2. Cracking the code. How to spot undervalued stocks like a pro. You might be wondering, how do I find these hidden gems that are undervalued? Great question. The first step is understanding what makes a stock undervalued in the first place. At its core, value investing is about buying stocks for less than they're worth. One of the key tools is the price-to-earnings ratio, P/E. A lower P/E can suggest that a stock is undervalued. For instance, if a company has strong growth potential but its stock price is lower than its earnings would suggest, it might be time to consider. Another important metric is the price-to-book ratio, P/B, which tells you whether a stock is priced higher or lower than its actual value. If a company's P/B is under 1, that can signal it's undervalued, especially if its financials are solid. Look at debt levels too. A company with too much debt is a risk, but if a business has low debt and strong cash flow, it might be an attractive opportunity. Dave Ramsey emphasizes financial health, and this also applies to the companies you invest in. Companies with solid balance sheets are safer long-term bets. It's important to do your homework. Dave Ramsey recommends reading the financials of any stock you're considering. While this may sound boring to some, it's one of the best ways to avoid making emotional decisions based on hype. The numbers don't lie. A unique tip is to pay attention to insider buying. If the executives of a company are buying up shares, they probably believe in its future. You can learn a lot from these insider signals. Did you know that over 90% of Warren Buffett's investments have been in companies with strong fundamentals, not necessarily the latest trends? It's a smart approach that focuses on the company's true value, not just the next big thing. Chapter 3. The power of compounding. How small investments create big returns. One of the most powerful forces in investing is compounding. This is how small, regular investments can grow into something much bigger over time. Albert Einstein called it the eighth wonder of the world, and for good reason. It's the magic behind long-term wealth. To illustrate, imagine you invest $100 a month starting at age 25 and earn an average return of 8% a year. By the time you're 65, you'll have over $200,000, without ever investing more than that $100 monthly. This is the magic of compounding. Dave Ramsey always emphasizes the importance of starting early, and this is why. The earlier you begin, the longer your money has to grow. In fact, if you start investing just 5 years earlier, you could end up with 50% more in retirement savings by age 65. Let's look at some real data. According to a study by the Motley Fool, a person who invests $1,000 at an 8% annual return will have nearly $22,000 after 30 years. Not too shabby, right? Another interesting fact: the power of compounding works even when you're not actively contributing large amounts. Small amounts, if invested consistently, add up over time. This means you don't need a huge amount of money to start. Dave Ramsey's baby step approach, which encourages you to begin with small amounts while paying off debt, is a great foundation for this. It's also critical to understand that compounding doesn't just work with stocks. It can apply to your savings, interest from bonds, or even reinvested dividends. Every little bit helps your investment grow. Remember the famous quote from Warren Buffett: "The most important thing to do if you find yourself in a hole is to stop digging." The same applies to investing. Instead of trying to time the market or chase after the next big stock, focus on building wealth slowly with smart, consistent investments. If you're enjoying this guide, make sure to hit the subscribe button so you don't miss the next chapters with more tips on value investing. Chapter 4. The Value Investor's Mindset. Thinking long-term in a world of instant gratification. In today's world, where everything is available at the click of a button, it's easy to fall into the trap of wanting instant results. But the most successful investors know that true wealth takes time to build. Dave Ramsey stresses the importance of having a long-term mindset when it comes to managing money. This approach is exactly what you need as a value investor. The key to success in value investing is focusing on the long haul. It's about making calculated decisions based on what a company is worth today, not what it might do tomorrow. This means ignoring the daily noise in the stock market and thinking about where a company will be in 5, 10, or 20 years. A famous quote from legendary investor Benjamin Graham, often called the father of value investing, sums this up perfectly: "The investor's chief problem, and even his worst enemy, is likely to be himself." Emotional reactions to market swings can lead to rash decisions. Instead, value investors focus on fundamentals, which means staying grounded in your research and trusting the process. It's also helpful to remember that markets go through cycles. As a value investor, you'll experience both ups and downs. But by sticking to your strategy, you'll avoid selling when prices dip, and you'll be in a better position when prices rise again. The power of long-term thinking is proven by research. A study by J.P. Morgan showed that holding stocks for longer periods, such as 10 or 20 years, has historically yielded higher returns than trying to time the market. It's not about getting rich quickly, but about building lasting wealth slowly. Warren Buffett says, "Our favorite holding period is forever." This mindset is key to navigating the ups and downs of investing and making it through to the other side as a winner. Chapter 5. Building a value-focused portfolio. Balancing risk and reward like a pro. One of the biggest mistakes new investors make is thinking they have to pick just 1 or 2 stocks and hope they do well. In reality, a well-balanced portfolio is your best defense against risk. Dave Ramsey often talks about the importance of diversification in his financial plans, and this holds true for value investing as well. A value investor's portfolio is typically made up of companies that are undervalued but still have strong fundamentals. To reduce risk, it's smart to spread your investments across different industries, sectors, and even types of assets. For example, you might invest in undervalued companies in technology, healthcare, and consumer goods. The goal isn't to pick stocks that are all performing well at the same time, but to make sure your portfolio is resilient enough to withstand downturns in any one area. By doing this, you reduce the risk of losing everything if one sector or stock underperforms. Studies show that diversification can help investors avoid big losses. According to a report from Vanguard, a diversified portfolio can reduce risk by as much as 40% compared to holding a single asset. This doesn't mean your returns will always be smooth, but it can help you weather tough market conditions. One key to building a successful portfolio is not just focusing on stocks, but also considering bonds, mutual funds, or ETFs. These other assets can provide stability during times of market volatility, allowing your stock investments to grow without as much risk. You can also balance risk by incorporating dividend-paying stocks into your portfolio. These stocks provide regular income, which can help you stay the course even during market dips. As you build your portfolio, remember this advice from Dave Ramsey: don't put all your eggs in one basket. By investing across different sectors and assets, you ensure that you're not overly reliant on one investment to carry you through. Chapter 6. Mastering the market's mood swings. How to stay calm when stocks fall. One of the hardest parts of being an investor is learning how to deal with market volatility. Stocks go up, stocks go down, it's part of the game. But while many investors panic during a downturn, value investors keep their cool and stick to their plan. Dave Ramsey often talks about avoiding emotional reactions when it comes to managing money, and this is particularly important when investing. The key to surviving market drops is to remember that short-term drops are normal, and they don't necessarily mean that a company's value has changed. If you've chosen your stocks wisely based on fundamentals, a market dip might just be an opportunity to buy more at a lower price. Buffett's favorite saying is, "Be fearful when others are greedy and greedy when others are fearful." This is the essence of value investing. When everyone else is selling out of fear, it might be the perfect time to buy. This strategy allows you to buy undervalued stocks during times of panic, which can lead to huge rewards once the market recovers. Data from BlackRock shows that investors who stayed invested during major downturns in history, such as the 2008 financial crisis, were far better off than those who sold during the panic. The market always rebounds in time, and those who stay the course are typically rewarded. Another trick is to set long-term goals and stick to them, no matter what the market is doing in the short term. This takes discipline and patience, but it's worth it. In fact, research shows that investors who stay invested during market dips end up with higher returns over the long run than those who try to time the market. It's also important to have a plan for how much risk you're willing to tolerate. Knowing your risk tolerance helps you stay calm when the market dips, because you'll have confidence in your strategy. According to a study by Fidelity, investors who had a well-defined investment plan and stuck to it had 50% more in their accounts after 10 years than those who didn't have a plan. In the end, market downturns are just part of the investing journey. By focusing on the fundamentals, sticking to your value investing strategy, and not letting emotions guide your decisions, you can avoid the common pitfalls that lead many investors to panic sell. Congratulations! Now that you've completed this guide, make sure to subscribe and turn on notifications so you never miss an update on the smartest strategies to build wealth through investing.